Welcome to Everyday Economics, the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, CEO of the 501c3 nonprofit nonpartisan Franklin News Foundation. Everyday Economics, a production of America's Talking Network. You can subscribe to all of our podcasts at americastalking.com. To support Everyday Economics, please make your tax-deductible charitable contribution by clicking the link in the show description. We are recording this episode on Wednesday, February 14th, and joining me, as always, my friend, my colleague, the great Dr. Orphe Divounguy. Dr. O, I want to hop right into it. We on the previous podcast, we talked about the economic data that came out this week. Consumer price index was up 0.3%. On a 12-month basis, that's 3.1% increase. We've got other factors in the market that are influencing the way that investors are looking at the marketplace as a whole. We were recording this on Wednesday. On Tuesday, bond market had a pretty interesting day. And if you have a portfolio, a brokerage account, or if you trade stocks, or if you paid very close attention to your IRA or your 401k and you're invested in the stock market and bonds, you saw what was, I believe, reported to be like the worst day in the market in a year. So could you help us to make sense of what's going on out there? I mean, as we look at the Dow today, and in particular, the Nasdaq is really rolling. It looks like there's been something of a recovery, but Tuesday was a day of bumps and bruises for investors.
Totally, but you look, what happened is, I think the market always overreacts. I wrote about this on my LinkedIn page, by the way. I hope you guys follow me on LinkedIn. And it was hilarious to see the crazy reaction. I said, look, this happens every time, right? The market always overreacts, goes too far, swings too far one way or the other, and then makes the adjustment the next day. Core inflation comes in. We have, stickier than expected, right? We see a small uptick in the month-over-month number. And everybody panics. At the end of the day, the biggest component in inflation, almost half of core inflation, is housing. And what you see when you look at Zillow's rental market updates, monthly updates, is rent growth is cooled. Apartment rents have cooled so much. I mean, on a month-to-month basis, they were negative. On a year-over-year basis, there was something like 2.6, 2.7% year-over-year, lower than before the pandemic. Housing, single-family rents decreased. Single-family rents still a little bit high when compared to the pre-pandemic period, but also down from 16% on an annual basis to about 4.1, 4.2% year-over-year. So you have a normalization. The biggest component of the consumer price index, housing, has normalized. And so there isn't all that much inflation left out there, except for sectors that have been plagued by labor shortages, like the healthcare industry, one-time blips, like one-time bumps on the road, like insurance prices. And so there's still a ton of disinflation out there. And so the overreaction on the day like yesterday, to me, is a buying opportunity. And by the way, we don't give investment advice on this show. We don't.
There's a reason why. We're not qualified to do that. And,
That's right.
And we're not going to pretend that we are.
But I'm here to tell you about what's going on in the economy. And what's going on in the economy is the disinflation trend is here to stay. The Fed will keep interest rates high enough for long enough to make sure that happens. And then it's a matter of when they will cut interest rates to recalibrate policy to make sure real interest rates don't increase and choke the U.S. economy, right? And as long as inflation continues to go in the right direction, then the consumer will be fine. That we will likely avoid a recession. Then interest rates will get cut. And as long as the consumer is okay, then Wall Street will be good.
Yeah.
We did an episode in the past where I said what's good for Main Street is good for Wall Street. And and things are going to continue to head in fact, the fact that the Fed is not cutting immediately and is making sure inflation returns to target is good news for Main Street. And that means it's good news for Wall Street. So I thought yesterday was a great buying opportunity for a lot of these stocks out there that are still somewhat undervalued. Look, there's a broadening that has to happen in the stock market, in my opinion. Yes, the big tech giants are going to continue to do well, are likely to continue to do well, especially in a rate cutting environment. But a lot of these smaller companies that are really, really strong companies are likely going to see to breathe signs of life when as inflation comes down and labor costs come down and the Fed cuts interest rates later in the year.
Yeah. So can we talk a little bit about like what's going on with interest rates for homes right now? I mean, I think that there's been a pretty significant reaction in news media in the last, I would say, really maybe since Monday. Maybe it started last week. We talked about that there's been an uptick in mortgage rates. And I guess the national average at this point is just under 6.9%. It's like 6.87.
If you follow
the week before it was 6.80 or 6.79 or something like that. So I mean, you talk about like sort of hyper reactivity to economic data. I mean, if I'm needing to buy a home, and I see like a 0.1% increase. I mean, I'm not saying that that's not consequential over the term of 30 years, but of course, rates rise, rates fall. Refinancing is a fundamental part of owning a mortgage. If those opportunities present themselves, which historically they have. I mean, is this really going to have a detrimental effect to the home buying market right now?
I think that's a great question, Chris. I get this question. Quite a bit now, the past week or two, because mortgage rates have increased, right? So the increase in mortgage rates, mortgage rates kind of tend to follow the 10-year Treasury note, and the 10-year Treasury note has been going up. Went up a lot yesterday in reaction to the stronger inflation report. But again, I think that as long as inflation continues to move towards the 2% target, you're probably going to have the 10-year come back down a little bit and mortgage rates ease somewhat. Mm-hmm. Now, I don't expect mortgage rates to drop, but I don't think they're going to continue to increase. I think, again, it was a overreaction by the market yesterday. In fact, if you look at your screen today, the 10-year note is already falling. And
stocks are rolling.
And stocks are rolling again. Exactly. So I made that prediction yesterday. I just thought, and it happens every time. It's not very hard to make those moves because we see it all the time. It's just the way of the world. This is the way the market reacts to economic news. And so if you paid attention, you made the right moves. In terms of the housing market, though, to answer your question, in the last year, higher mortgage rates didn't just have an impact on demand. It had an impact on supply as well.
Right.
The flow of existing homes coming on the market had fallen. I think the worst of it was like negative 35% when compared to before the pandemic. That has improved somewhat. And when you look at the supply, the flow of existing homes, it's actually increased relative to last year. In January, it's up 6% year over year. And so you're starting to see that even, despite the higher mortgage rates, more sellers are coming on the market relative to a year ago. And so that, I think that bodes well for housing sales in the spring, in this spring season. Now, of course, mortgages have increased again. But like I said, I don't think that's going to continue. I think rates are probably going to ease. The 10-year yield's probably going to ease around 4%. It's been fluctuating. It was up 30 basis points yesterday. It's back down a little bit again. It's probably going to settle around the 4%, 4.25% mark. Mortgage rates are also going to settle down a little bit. They were up above 7% yesterday if you followed the daily action on Mortgage News Daily. And that's going to come back down. It's going to come back down in the 6s range, like I predicted at the end of last year. I think we're going to stay in the 6s range. I don't think we're going to see rates falling below that unless, of course, we get into some economic trouble. But I don't see that happening. So that's the outlook for mortgage rates. You just have to look at Zillow data again for last year. Last year, rates were about 7.13% in May of last year. Mm-hmm. And what we had was more demand than there was supply. We had strong price growth in May of last year. And so I think demand's going to stick around. It's just really a matter of whether or not we continue to see the uptick in the flow of homes coming on the market, because that was the constraint on sales in 2023.
Well, I appreciate your thoughts as always, and that's super insightful. Thanks again, Dr. O. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other high-quality podcasts at americastalking.com.